Everybody, and welcome to the Insurance Journal's Academy of Insurance's weekly webinar after show. I'm your host, George, and joining me for the after show today was the instructor for today's class. Today's class was Parametric Risk Contracts, Not Your Traditional Insurance Product. And our instructor is Mr. Joe Harrington. Joe, welcome to the after show. It's great to have you here.
Thank you very much, George. Great to be here.
Fantastic. Joe, why isn't, you went over this in the class really thoroughly, but why is parametric risk not your traditional insurance product? I mean, it's a huge market share of insurance claims and things like that, but I'm not sure if that's the only reason or maybe a whole different reason. Can you tell us why it's not your typical insurance product?
Yeah, typically when we think in terms of insurance, we think in terms of what we call indemnity-based insurance, that you demonstrate that you have suffered a loss. There is a whole, particularly on the property side, but also on the liability side, a claims process to determine the amount of the loss, whether the loss falls within the insurance contract, and then compensation is paid. It can be more precise, but it takes a longer period of time. And it's also limited. Both the payout, rather the grounds for paying out, and often the proceeds themselves are restricted. You suffer damage to your home, you'll receive an ACV check for the damage. If you want the replacement costs, you have to make the repairs and then go for that. And that's what you can do. You can't, you're not, it's not supposed to work on you suffering damage and then taking the money and walking away. It's not ideal. It's possible, but it's not ideal. The parametric, allows risk transfer to go beyond that. The traditional insurance model is heavily based in financial practices, in law, and everything else, and it's a rational approach, especially to building property. Great values that need to be evaluated accurately and covered as such. But then there are other types of events, occurrences that can qualify as losses. And that is, your business is in the middle of a district. You haven't suffered direct damage, but the area has, and you lose business accordingly. That, is pretty well established in business income coverage. But now with parametric insurance, we can get money faster to people for a wider variety of losses. So now, as I was discussing, you run a hotel in a location, and the warnings come, and there are objective conditions for those warnings. There is an index. There is certain air pressure and things forming over the Atlantic and so forth and so on. That this is not some subjective worrywart type of alert. It is an objective reaction to something that's happened objectively and is measured by an index. And you lose business even before the storm hits landfall, even before there's been any kind of physical damage. You're already losing business, and that is a loss. And that is a loss in which you could have an insurable interest, and therefore parametric coverage is permissible in that regard. If you get into situations where you don't have a loss, so certain things happen out over the Atlantic, and for whatever reason they don't result in any kind of closures or even any slowdown in consumer traffic, it would be a problem if you were to be able to collect on that just because those conditions were met. regulators are not going to allow that on any regular basis, and the people underwriting these things are not going to want that. So whatever theoretical problems there may be in that regard, as a practical matter, everybody is working to prevent that, and it's not going to hobble the progress of parametric coverage. Have I answered your question?
Yeah, sure. No, you have.
Yeah,
so there's no aggregate limit.
Traditional that you can cover for more types of losses, for more types of perils, and on a much more flexible basis.
So there's no aggregate limit. I mean, or is there in a parametric policy? Can you get parametric coverage? But I mean, there's no telling what the limits. You'll
negotiate a limit and amounts that will be paid out. And I think today, I'm not firsthand in it, but there's a level of loss that you're going to have. So if you are a Florida municipality and a certain storm of a certain intensity hits you, between overtime, damage to your buildings, other things that you are certain to,
sure,
suffer, say, $25 million in losses to address it. And if you get parametric coverage for $10 million, all right, that's not going to cover you entirely, but it's going to cover you quickly and allow you to maybe, mitigate that 25 million down to 22 or 20 million. You probably, the whole package will almost certainly involve some indemnity coverage where ultimately, every loss is documented. But if you can get the parametric coverage at work earlier in the process, it meets certain needs, it provides certain benefits for everybody involved.
So speaking of the speed at which you're, made whole again, if I understood you correctly, parametric pays upon occurrence and doesn't wait for a claim to be filed. Is that correct? And is that unique to insurance?
Well, the whole point of parametric is it pays upon agreement that the index has been triggered. And, so we're talking about within days or something, the money is out there. So again, your Caribbean island gets hit by a Category 4. They're going to get part of their coverage right away because they need it right away to save lives, open up streets, protect property, clean up all the damage.
Sure.
They're unlikely to have all of their coverage for all of their losses. And ultimately, at the end, and whatever you claim in on an indemnity policy would be offset by what you got from a parametric policy. So, I can't imagine anybody, again, like I said, I don't work within this, but I can't imagine anybody preparing a package that says, okay, you'll get 10 million in parametric coverage, and then you'll get your full 25 million later on. No, I mean, then that would be a game. You cannot have a range, and no serious actor is going to create mechanisms that are going to give the quote unquote insured a gain from this. It is something that has come up from the outset, something that had to be avoided, and it is effectively. The problem with the basis risk is, for, someone who has coverage, suffers a loss, but for whatever reason, the parameter is not triggered. And that's another reason why, no one with a substantial risk program would put all their eggs in a parametric basket. There will still be indemnity coverage.
So you said that 70% of parametric perils are due to natural catastrophe. Mm-hmm. That was in your presentation. Not to ask you for super specific stuff, but can you give us a broad stroke about what the other 30% might entail? If it's not natural, what else would be the trigger for a parametric if it's not natural catastrophe?
Yeah. if it's not natural catastrophe, one, it may be natural conditions. So you think about that milkshake product, and a heat wave is not necessarily a natural disaster in the same sense. It's extremely hot. It has impacts. It doesn't cause widespread building damage or necessarily death, but it affects cattle. So there is an impact. It's an unusual event. It's a severe event. It may not be a disaster event. So there would be things of that nature that they may be severe in a weather sense, but not creating the disaster, the physical damage of a disaster, and yet creating conditions that lead to losses, that lead to situations where people have to, do something. And in some respects, it could be, good things. I mean, I believe this is in place that ski resorts can buy parametric coverage if there's an agreement that, snowfall has fallen below a certain expected level.
Oh, yeah.
And, you can't accommodate, then there could be, I'm pretty sure that is in place and could be in place, but that kind of thing, it is a loss. The important point is it is a loss. A ski resort would normally expect to make so much in a year with extraordinarily little snowfall. So that's, not a natural disaster. No one's, crushed by the lack of snow, but it has an economic impact that, is a loss. And therefore, you can write coverage for it. The other thing is, I don't know. I would find it hard to imagine, and again, here's where you need to really talk to someone in the business of writing these themselves.
Right.
Parametric coverage for a localized peril is, I think, where it's least easily adapted. Do I have fire? Do I make fire coverage on my property? For a local fire that breaks out in my own building, available on a parametric basis. It's harder for me to picture, but people are hard at work, doing this stuff. And it may be that certain conditions make that more likely, but the event itself is key. And I just don't know. I'm sorry. Here's where I'm an observer of the business, not in the business. And
well, that's okay. I mean, that was
confessed
for someone who is not in the business. That was a great answer, and that was an interesting reverse use case. When you think of parametric and catastrophe, you don't think of sort of a reverse catastrophe, which is a ski resort planning on a certain amount of snowfall, not getting it and losing business. That's interesting. I didn't think of that, but that's why we have you.
Or if lake levels were at unusually low, and that affected either tourist business or fishing business or something else,
right?
These are not things that happen all that often.
Sure.
The big ones are events that include, strong forces, physical damage, plus the immediate need for cash to go to work and not wait around for a claim process.
I just have a couple more quick questions, and I'll ask them both at once, ideally.
Right. Whatever.
So you mentioned that parametric insurance is a $16 billion industry globally. And you, that was in your presentation, and you mentioned that by 2034, you estimated, or the figure you had for an estimated global, level of
51.3.
51. Yeah. And you said, and I think you've said this before in classes, that insurance moves at a glacial, or moves glacially. But in terms of the industry climbing from 16 billion to 51 billion, is it going to be due, in your estimation, just totally generally, like to more natural, like, maybe global conditions contributing to more natural catastrophes, or what do you attribute the rise of that to? And I guess I'll just ask that one question.
Well, yeah, compared to traditional risk transfer and compared to traditional insurance, parametric moves at jackrabbit speed because it can select the parameters, select the limit, the coverage conditions. You don't have the same need for the same types of applications, exclusions, limitations, and so forth. An event happens, you're almost certain to have a loss, will pay out, and you use the money how you want. It's just a much more simpler conceptually. And if you have the ability to determine what you will pay and the ability to make an efficient case that there has been a loss, even if it's not thoroughly documented or substantiated yet, then this thing can move along more quickly. And it is much more of a matter between, two contractors and not a matter of selling to the general public, as say. Now, as Parametric moves into lines like homeowners and others, as it's incorporated as a potential a complement to them, then there needs to be consideration for, do people know what they're buying? Do they know what they're giving up if they say take, if for some other reason you take a lower building property limit in exchange for parametric coverage, that means that lower building property limit would apply whatever the loss, and your parametric may not respond to that. So if you get if you have a component to your homeowner's risk package that includes a parametric wildfire policy, an event of a certain magnitude happened and it's determined, and your home was burned as a result of that, and you get a certain amount, then you may have full replacement cost. But if you determine, I'm going to take a smaller limit, I live in Southern California or I live in Arizona, whatever, I'm going to take a lower limit on my structural replacement cost, and get this wildfire parametric coverage, and basically take the risk that if I have a local fire within mine, I leave a stove, I leave the stove on or something, and I have a fire that destroys my house, I may be short of money because that parametric is not going to reply to that. And this is rather speculative on my part. I don't think regulators will be looking out for this as well as insurers. They need to let people know if using any of this puts them at risk of being underinsured. If you transfer your coverage from an indemnity-based, it's one thing to have an indemnity-based policy and then buy a parametric on top of that, and extend your potential for coverage. Although once again, you still can't, claim more than the loss that you've taken on the property. You can't profit from any parametric coverage, but you could lose if you think, well, I think it's a better financial deal to drop my location fire coverage, go with parametric wildfire coverage and take my chances. You could be out of luck in that circumstance, and I'm sure regulators are and will be quite vigilant about that.
So parametric can't be used as kind of like a excess liability coverage. You couldn't have it be a kind of an umbrella thing where, you know, two totally different things.
I'm not saying it can't, but as a supplement, you have, I'm sure there's going to be regulation to make sure people know what they're deciding on.
Sure.
And that they're not, one of the virtues of parametric is that you can create a variety of contracts, and that's great for commercial accounts that, have sophisticated risk management capability, or at least access to it. For homeowners, you need to know what's at stake. If parametric becomes part of homeowners, people need to know, one, they can't make money from their parametric. I know that's not going to be permitted, although it's going to be also equally hard for insurers not to grant coverage that's supposed to be there. So I can imagine some conflict arising over that. But I think it'll be rare and maintained. Everybody, regulators, insurers, everybody understands indemnity and understands sticking to the principle. The thing is whether buyers will be tempted to sacrifice some of their indemnity coverage for parametric coverage, which might save them money in some circumstance or another, but provide them less coverage, in the sense that unless that parameter is reached, that coverage isn't going to happen. And Lord knows, in wildfire in particular, one would hope, if you have a wildfire in an area, as Southern California has experienced, wildfires consume their own fuel. And one hopes that those folks will rebuild in a way that doesn't leave all that fuel and all that exposure to wildfire. So, someone traumatized by a wildfire loss might have incentive to purchase a wildfire, or a component of coverage that's wildfire parametric,
right,
at a time when the chances of hitting that parameter have hopefully fallen. Hopefully, we will have improved, the fire load situation in Southern California when we rebuild. It would be almost criminal if we don't.
I guess I do have one last question. Do you think, because of the opportunity, because of how the huge scope of it being a $16 billion global industry, it being a $5.5 billion U.S. industry, do you think that would be a good recruiting tool for people to get into the insurance business and sell parametric?
Well, it will certainly be a good method for for further tapping investor interest in investing in insurance loss. It still is, there are, we don't have time here to go into insurance-linked securities or cat bonds or so forth.
Sure.
But these are situations where somebody puts up money, gets their share of premium payments, and then if nothing happens, they pull back their principal and they've made what they've made. And these is, believed to be, what gains and losses are not correlated with other market gains and losses. So it's a good portfolio balance tool and so forth. Okay. With a parametric, more people may enter. There might be more capital to support the transfer of what we have traditionally called insurance risk. But now we can expand it to other types of risk of loss, dependent on circumstances outside the insured's control. And it's important. These losses must be fortuitous. All right. They must entail some degree of actual, damage to property or loss of income or extra expenses, and not be mere speculative or economic losses. Not just that my house didn't, enjoy the appreciation that it did because we had, a couple of tornadoes in the area, at one time. That's, I think that's going to be hard to have any kind of risk transfer that's treated as risk transfer. And if anything becomes a derivative related to economic value, then it's going to be regulated as derivatives. And that's a whole nother thing. And that's something that people in the risk transfer business generally want to avoid. Got it.
Joe, your class was amazing today. Parametric risk contracts, not your traditional insurance product. Thanks for spending a couple extra minutes with me. I think this is a little bit of a longer after show than we do, but I just had a lot of questions. It's an interesting, so risk. So thank you so much for your time.
Well, thank you for the opportunity.
On behalf of our instructor, Joe Harrington, this is George saying thanks everyone for coming today. We'll see you at the after show. Have a great day. Oh, no, I'm sorry. I want there to be more after show so much, Joe, that I just said we'll see you at the after show. Thanks for coming to the after show, and we will see you next time. Have a great day, everybody. Take care.
Thank you, George.